Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, I am really looking forward to this deep dive today because there's just a lot of shifting ground right now.
There really is. Imagine checking your retirement account tomorrow morning. You expect to see your money safely spread out across, normal stocks like Apple or Amazon.
Right, the usual safe bets.
Exactly. But instead, you realize a huge chunk of it is locked up in some private loan to a mid-sized car wash chain across the country.
Oh, wow. Yeah, and you can't easily sell it either.
Right. If that sounds bizarre, well,
No.
buckle up because that is exactly the road we are heading down.
It sounds wild, but based on recent analysis, it's a very real possibility.
Today, we are focusing entirely on this massive underlying shift in the U.S. economy. Based on recent analysis from March 30, 2026, we're looking at Federal Reserve Chairman Jerome Powell's latest speech at Harvard.
Which was a really telling speech, by the way.
It was. And we'll also cover the sudden return of a word economists absolutely hate, stagflation. Plus, we'll get into a surprising new draft rule from the government that could soon pipe complex, opaque Wall Street private debt directly into your everyday 401k.
Yeah, it is a critical time to pay attention to this stuff. The financial landscape is fundamentally changing how risk is managed.
And I know that terms like bond yields and shadow banking sound incredibly intimidating. They
Yeah.
sound like things you need a fancy Wall Street degree to understand.
No, totally. It sounds like a foreign language sometimes.
Right. But our mission today is to strip away all of that institutional jargon. We're going to look at how these high-level decisions made in marble buildings actually dictate the cost of your groceries, the interest rate on your car loan, and the safety of your nest egg.
Exactly. It's about figuring out who ends up holding the bag when things go wrong.
So let's start right at the top. To understand the chaos in the markets right now, we first have to look at the guy steering the ship, Jerome Powell.
Right, the Fed chairman.
Looking at the data from his March 30th remarks at Harvard, Powell was addressing the massive shocks hitting the global economy right now. Specifically, the war in Iran and the way it has caused global oil prices to absolutely spike.
Yeah, energy costs are just shooting through the roof.
Now, you might think a crisis like that would demand immediate action, but the analysis of his speech shows his strategy is essentially to just buy time.
He's playing a waiting game.
Exactly. He made it clear the Fed is going to keep interest rates frozen for now. His argument is that supply shocks, like a sudden massive jump in gas prices because of a war overseas, are often temporary.
Right, because monetary policy takes a long time to actually work. If you pull a lever to raise or lower interest rates, it can take, 12 to 18 months to actually affect how everyday Americans spend money.
So it's not an instant fix. Think about it like driving your car down a Midwest highway in the dead of winter.
Yeah.
You were cruising along, and suddenly you hit a patch of black ice.
Oh man, the worst feeling.
Right. That black ice is the sudden war and the energy shock. If you panic and violently jerk the steering wheel, or if you slam your foot on the brakes...
Which would be like rapidly raising or cutting interest rates.
Exactly. If you do that, what happens? You overcorrect, your tires lose whatever grip they had left, you spin out, and you crash the car into the median.
Yep, you cause a much bigger disaster by panicking.
So Powell is choosing to grip the steering wheel firmly, keep his foot steady on the pedal, and just coast until he knows exactly how slippery the road actually is. He's doing nothing. Deliberately.
And the mechanics of the economy make that do-nothing approach almost mandatory here. Powell is acknowledging a very dangerous set of dual risks.
What do you mean by dual risks?
Well, on one hand, the war and high oil prices are a huge drag on the economy. Businesses pay more for shipping, you spend more at the pump, so economic growth just slows down.
Okay, so normally that would be a reason to cut interest rates, right, to stimulate the economy.
Exactly. But on the other hand, those same high energy costs bleed into the price of literally everything else and push inflation higher.
Which means they should raise rates.
Right. So you have these two risks pulling the economy in completely opposite directions. His baseline policy is simply to observe, don't rush a hike, don't rush a cut, just keep the car steady.
Okay, I understand the logic of keeping the car steady, but here is where the data doesn't seem to match the rhetoric.
How so?
Well, if Powell is calmly coasting, telling everyone, hey, we're just going to wait and see, no sudden moves, Why did the bond market absolutely lose its mind?
Yeah, the bond market reaction was brutal,
Looking at the recent market data, the 2-year and 10-year U.S. Treasury yields shot up over 40 basis points in just a single month.
which is a massive move.
It is. And I want to pause here to explain what that actually means for you listening. 40 basis points might sound like tiny Wall Street math. I mean, it's just 0.4%.
Right, it sounds like nothing.
But in the bond world, that is a violent earthquake. If that translates over to your mortgage rate or your auto loan, you are suddenly paying hundreds of dollars more a month just because the market sneezed.
It hits your wallet directly.
Exactly.
Yeah.
So if Powell is acting calm, why is Wall Street panicking?
Because the bond market isn't reacting to what Powell did. They are reacting to what his hesitation actually means behind the scenes.
Which is what?
It means the Fed is trapped. Let's look at the context from earlier in the year. The market was incredibly optimistic. Investors fully expected the Fed to cut interest rates multiple times.
Because cuts make borrowing cheaper and push stock prices up.
Exactly. But by the end of March, that optimism just evaporated. Investors looked at the war in Iran and realized that while it hurts economic growth, it is a much bigger, much more dangerous fuel for inflation.
So they see his patience as paralysis.
Yes. The market interpreted Powell's wait-and-see approach as a trap. The Fed cannot easily lower rates to rescue the economy, even if growth starts to plummet, because inflation is tying their hands.
And if growth plummets while inflation stays high, we crash right into the S word that everyone in finance is absolutely terrified of.
Stagflation.
Yes, stagflation. If you're driving home right now or listening at the gym, let me break down what stagflation actually feels like for your wallet.
It's a brutal feeling.
It is the absolute worst of both worlds.
Yeah.
Imagine you go to work and your boss pulls you aside and says, hey, times are tough, the economy is slowing down, we have to cut your hours by 20%.
So your paycheck shrinks.
Right. That represents economic stagnation. But on your drive home with your smaller paycheck, you stop to get gas and pick up some groceries, and you realize the price of your commute and your food is just doubled.
That's the inflation part.
Exactly. You have significantly less money coming in, but simply surviving costs twice as much. You're being squeezed from both sides. That miserable squeezing feeling is stagflation.
And if we apply that exact same squeezing feeling to the bond market, we can understand exactly why those yields spiked so violently.
Because investors are feeling that squeeze too.
Yep. Bond investors are currently suffering what analysts call a stagflation-style loss. Historically, the Wall Street playbook was very simple. When a scary global risk happened, like a sudden war, investors panicked and bought U.S. government bonds.
Because they're considered the safest asset on earth, right?
Exactly. And when everyone buys bonds, their price goes up and their yields, or the interest rates, go down. But right now, because of the energy shock, that old playbook is completely broken.
Wait, so bonds aren't safe anymore?
Well, investors can no longer just blindly bet on long-term bonds as a safe haven. Why? Because inflation eats away at the fixed returns of a bond. If a bond pays you 4% a year, but inflation is running at 5%, you are literally losing purchasing power by holding that safe asset.
Oh, wow. So you're locking in a guaranteed loss.
Right. So investors are demanding much higher yields right now just to compensate for the risk that oil prices will keep pushing inflation up.
So because of this stagflation fear, bonds are losing their magic, and interest rates have to stay painfully high for a long, long time.
Which puts a ton of pressure on everything else.
Exactly. We all know that when interest rates stay high, the cost of borrowing money becomes oppressive. The pressure in the financial system builds up. Eventually, something is bound to crack.
It always does.
Which leads us directly to the next major point in Powell's Harvard speech. His specific warnings about a massive, opaque corner of the financial world known as private credit.
Yes. And before we dive into Powell's comments, let's clearly define what we mean by private credit and shadow banking.
Yeah, because shadow banking sounds like guys in trench coats making back alley deals.
It really does, but it simply refers to lending that happens outside the heavily regulated traditional banking system.
Okay, so give me an example.
Sure, if you are a mid-sized software company and you need $100 million to expand, but a traditional bank like Chase or Bank of America says no because the rules are too strict, you go to the private credit market.
Who are the lenders then?
These are massive investment funds that pool money together to give you that loan. It is unlisted, it is highly customized, and it is largely outside the view of everyday public markets.
Right. And according to the data, Powell addressed this specific market directly. He
Hmm.
stated that while the Federal Reserve is watching private credit very closely because of the high interest rates, they do not view it as a 2008-style systemic crisis.
Meaning they don't think it's going to collapse the whole global financial system.
Exactly. The argument is that the private credit market, while growing rapidly, is still limited in size compared to the broader economy, and traditional banks aren't dangerously overexposed to it.
Right.
To put a visual on this for you listening, think of the risk in private credit, like finding a leaky pipe in your guest bathroom.
That's a great way to look at it.
Is it annoying? Yes. Is it going to cause some localized expensive water damage to the drywall on the floor in that specific room? Absolutely.
Oh, yeah, it'll be a mess.
But it is not a giant structural crack in your home's main foundation that is going to cause the entire house to cave in on you.
Yeah. Right. And the reason that distinction is so important comes down to the mechanics of who actually holds the debt. Back in 2008, the foundation cracked because bad subprime mortgages were heavily intertwined with everyday depository banks.
So if the mortgage failed, the bank failed, and everyday people couldn't get their money out.
Exactly. But with private credit, these loans are generally held by locked-in institutional investors, pension funds, sovereign wealth funds, wealthy accredited investors.
People who can afford to take a hit.
Right, and the money is locked up for years. So if a mid-sized software company defaults on its private loan, the institutional fund takes a hit. The drywall gets ruined. But it doesn't instantly trigger a run on your local bank.
That makes sense.
Huh?
But Powell still sounded pretty cautious, right?
Absolutely. Powell's message basically translates to localized losses are guaranteed even if a systemic collapse isn't. High interest rates sticking around will cause a very painful repricing in these markets.
Repricing meaning these loans are suddenly worth a lot less.
Exactly. In an environment where money is expensive and liquidity is completely dried up, individual losses are going to pop up everywhere. You might see the acronym BDC floating around the research.
What does that stand for?
That stands for Business Development Company, which are essentially publicly traded funds that invest in these private loans. Investors holding BDCs or high-yield bonds really need to be vigilant right now because the pipes in that guest bathroom are definitely groaning under the pressure.
Wait, hold on a second. This is where I have a major disconnect looking at the research.
What's the disconnect?
You're telling me Powell knows these private credit markets are groaning. We've established that this is an opaque, slightly risky area of the market where localized losses and painful repricings are a mathematical certainty because interest rates are so high.
Yep, that's the reality.
If that is all true, why on earth is the government suddenly trying to pipe these exact same risky assets directly into our retirement accounts?
And that is the massive plot twist in the data. This connects to a structural change happening right behind the scenes, and it directly impacts the nest egg of almost every working American.
It's wild. What is actually going on here?
According to the March 30th analysis, the Trump administration's Labor Department released a draft outlining new rules for retirement plans.
Okay.
This draft explains how fiduciaries, the people legally responsible for managing company retirement plans, can now start including alternative assets inside everyday 401ks.
So they want to put private credit in there.
We are talking about allowing private credit, private equity, and even crypto assets into the bedrock of American retirement.
That is just wild to me. We're taking the leaky pipe and connecting it straight to the main water supply. Why is this happening right now?
To understand why Wall Street is pushing for this so hard, you just have to look at the sheer scale of the money involved. By the end of 2025, total U.S. retirement assets reached a staggering $49.1 trillion.
Trillion with a T.
Yes. And within that ocean of capital, 401k plans alone hold $10.1 trillion. The private credit industry isn't just looking to sign up a few more wealthy billionaires. They want access to this massive, automatic, long-term pool of everyday American retirement money.
Because it's consistent, right?
Exactly. Think about the mechanics of how your 401k actually works. Every single pay period, every 2 weeks, millions of Americans have a portion of their paycheck automatically deducted and blindly invested month after month, year after year, decade after decade.
It's basically an infinite money glitch for whoever manages it.
For the private credit industry, getting access to that pipeline of continuous sticky capital is the absolute holy grail. It would drastically stabilize their own funding base, providing a never-ending river of cash to fund their unlisted corporate loans.
Panic calling their HR departments trying to pull all their money out of their 401ks by tomorrow morning.
Yeah, let's clarify that.
Based on the research, This new draft rule is not an automatic overnight free-for-all. The Labor Department isn't just taking everyone's money next week and dumping it into risky private debt.
Right, it's not happening tomorrow.
What this draft actually does is provide a legal roadmap. It gives legal cover to fiduciaries, but only if they can rigorously prove they have evaluated the liquidity, the high fees, and the complex nature of these alternative assets.
Yes, exactly.
It is opening the door, but there are still several heavy deadbolts on that door that have to be unlocked first.
Yes, that's a crucial point. It'll be a gradual bureaucratic shift. But we still have to recognize the fundamental mechanics at play here. This is a massive double-edged sword.
How so?
On one hand, proponents argue that this institutionalizes the shadow banking market. By backing private credit with the massive, ultra-stable pool of American retirement funds, you actually make that alternative market safer and more robust.
So you are essentially pouring concrete around the leaky pipe.
Exactly. But on the other hand, it raises incredibly serious long-term questions about the mechanics of liquidity and consumer protection.
Right, because 401ks are supposed to be liquid.
Yeah. A 401k is a liquid structure for the consumer. If you face a massive life emergency, or if a broader market panic occurs and you decide you need to pull your money out, you expect to be able to log in and sell your mutual funds.
And get your cash in a few days.
But private corporate loans are highly illiquid. You cannot just sell a private debt obligation in a millisecond like you can with a share of Apple stock. It is often locked up for 5 to 7 years.
Exactly. So we're essentially taking a private financial instrument that relies entirely on keeping money locked away in a vault for years, and we're trying to forcefully mash it together with consumer retirement accounts where people expect to see a daily balance that they can theoretically access at any time.
Right.
The liquidity mismatch there seems like a recipe for a massive headache down the line.
Precisely. The mismatch is the core issue. And while the corporate fiduciaries are tasked with managing that daily liquidity risk on their end, the underlying nature of the asset doesn't magically change.
Right, it's still a risky private loan.
It remains a complex, unlisted corporate loan, now resting quietly inside the bedrock of Main Street's retirement system.
All right, we have covered a massive amount of ground today, moving from the Ivy League all the way down to your biweekly paycheck. So let's synthesize all of this into one clear takeaway for everyone listening.
Let's do it.
Right now, the U.S. economy is trapped in a very tense, high-stakes waiting game. You have Chairman Powell at the Federal Reserve firmly holding the steering wheel steady, refusing to slam on the brakes despite the massive shocks from the war in Iran and spiking oil prices.
He's coasting on the black ice.
Exactly. He is terrified of overcorrecting and triggering a crash. But the bond market is equally terrified of stagflation, that miserable, squeezing combination of a slowing economy and soaring daily living costs.
What worst of both worlds?
Right. Because the Fed is paralyzed by inflation, interest rates have to stay high. That sustained high pressure is causing the pipes in the private credit market to groan and leak.
Yep.
And yet, paradoxically, at this exact moment of high financial pressure, new government rules are quietly paving the way for those very same private credit assets to enter the multi-trillion-dollar pool of your everyday 401k.
Which leaves us with a fascinating and perhaps slightly unsettling final thought to ponder as these new rules take shape.
What's that?
If everyday middle-class retirement funds become the primary automatic lifeblood for private, unlisted corporate debt, we have to ask ourselves a serious question.
Okay.
Does this finally democratize Wall Street's most exclusive high-yielding investments, giving everyday people a piece of the billionaire's pie? Or does it simply transfer Wall Street's hidden illiquid risks directly onto Main Street's shoulders? Next time you log into your retirement app and look at your balance, it is definitely worth asking exactly what is under the hood.
Don't forget to subscribe and hit that like button.